On today's show, 3 questions. Number 1, can we peek through the keyhole? Number 2, is something breaking with banks? And number 3, are we all feeling the inflation fatigue? Let's go.
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. Matt.
And I'm Rabih.
Yeah, you are. Just us two again, Rabih.
Welcome back, Matt.
Thank you.
How was Disney?
This is going to kind of relate to my topic, but we'll just hit it real quick, or I'll give you a quick summary. Had a great time. So for those of you that maybe don't know, I went on a Disney cruise with my 6-year-old daughter, my 4-year-old son, to the Bahamas. And it was super fun. Like my kids had a blast. Disney runs an unbelievable operation. And so again, had a great time, loved it. So happy we did it. And I'll probably never go on another cruise again. So
I was waiting for you to say but you
no,
went,
so
I won't go on
I think both things can be true. I really do. I think I can be super happy we did it and literally had an amazing time with everything about it was so great and loved it. The highlight was easily taking my daughter on the ship. They do for all the Disney people out there, you're going to know, the bibbidi bop princess experience where they dress you up like a princess and do your hair and give you all these things. You get a dress.
I can totally relate.
Yeah, you can relate. It was magical. My daughter was in heaven, and it was just the best thing to see her so excited, and she loves Disney princesses and all that. And so that alone made it worth it. But I think I'm done with cruising. Like I've filled my cruise cup. You know, everyone's got different cup sizes for everything, whatever it is in their life, and my cruise cup has been filled. And I think I'm good. But I will say the next morning after getting home, my son, because we got thrown off by the time change, 2 hours difference, right? Because we were back in Florida. So we got back to Utah. My son woke up at 5 a.m. the next day coming home, and we're laying in bed together. And he's like, "Dad, I want to go on another cruise for my birthday." And I was like, "Oh boy. Well, we're going to have a talk about it." Yeah.
Good luck controlling it.
Yeah, exactly. So anyway, good to be back. It was a great time. And I'm just not a cruise guy.
Well, happy to be back. Happy to have you back.
Thank you. Yeah. So let's jump in, Rabih. Let's talk about this theatrical, dramatic, I don't even know what this is. I love this question. Can we peek through the keyhole? Tell us what that means, Rabih.
Honestly, I was reading an article about the inflation data that's going to be released, and it is interesting. The government is shut down. There hasn't been any data coming in for a month, but they are releasing the CPI report. The reason they're doing it only one time is because they need to adjust the Social Security paychecks, and they need an indicator to how much inflation was so they can adjust it.
So by the way, we thought when I left town, remember we talked about it on 2 cents that we were going to end this shutdown. Maybe the powers of 2 cents we've reached the bounds of our power and our influence, I think.
Yeah. We can control economies. We can't control.
We break strikes.
Yeah.
Yeah. But the government is too powerful, apparently.
So I was reading this article, and they literally said inflation is the only game in town this month for Wall Street that is hungry for data. And I thought this is very theatrical and nice.
Yeah, so, very dramatic.
The best thing I could come up with was
great copywriting there.
No, I'm a numbers guy. Here's what you can get. Enjoy it. Anyway.
You're a numbers guy that people don't know, though, has a secret gift of improv. You've done improv and acting, right?
Yes.
Yeah, we're just learning more about Rabih as we go.
It's just, bundled social anxiety being released on stage. This is what it is. Anyway, so we got the CPI report this morning. Just to take a step back and look at it. The S&P, and the reason we're using S&P because it's the most efficient information crunching machine out there, not because it's the best investment. But the S&P 500 has been fluctuating with a larger, deviations than we usually expect. We're seeing 1% move up, 1% move down, etc. But if you look starting October 1st, which is the day the government was shut down, until yesterday, it was fluctuating between two parallel lines. We call them a channel, and it wasn't going anywhere. AKA, yes, there's noise up and down, but nothing meaningful that moves you from one price level to another until this morning. And we got this CPI report, and it showed up that inflation, kind of the headline, the main one, is ticking up. We were like 2.7, 2.7, 2.9. Now we're at like 3, right? So it's ticking up a little bit, up bit by bit. However, if we look at the core inflation, CPI, which is the headline CPI minus food and energy, back in March, which was the lowest point for it, it was 2.8. Then April, we got another 2.8. Then in May, we got 2.8. And remember, those are like a month and a half after the Liberation Day, all of the tariff. And then June, it ticked up to 2.9. July, up to 3.1. August to 3.1. And here we were like starting to worry, like, are those tariffs going to create a new inflationary cycle, or is it going to be a one-time bump in prices? And then, so they started ticking up. And now September just came in this morning, and we dropped from the 3.1 year-over-year change to 3. So finally, there is, I wouldn't say, oh, it went down. No, it's still growing.
Flatlined.
But the trend of it going up after Liberation Day has finally reversed, at least for one data point. And this is a big, big relief for the market. The S&P 500, NASDAQ, Dow Jones, all are making all-time highs today. S&P 500 is above the 6,800 level for the first time. So the market is really enjoying that and kind of saying this is a great indicator that the Federal Reserve will actually cut interest rates next week. Although the Federal Reserve, just like us, doesn't have access to data, at least they have one now that indicates that, yes, you can continue cutting interest rates.
Good news, right?
Good news. Good news.
Okay. So we got some information. You got the new car smell.
Yeah, for once.
We're feeling
Honestly,
good.
you know, when you haven't had, like, if you're having ice cream every single day, it doesn't do anything for you. But if you stop for a month and have one
Au contraire. I have ice cream. No, I'm just kidding. I don't.
Okay.
I do love ice cream, though.
I chose ice cream just because this is a friendly family podcast, so that's why. And then you suddenly get surprised by a random, deliciously flavored chocolate ice cream. You're gonna enjoy it more than the others. So this is me with the CPI report today.
Yes, you were so excited. No wonder you were so giddy this morning. You're like, we got data. And the market liked this, right? The market liked this data today as it was released.
Yes, across the board. It's a really big day. And it was such a big news that, the president decided to stop all negotiation with Canada last night.
I saw that.
And the market didn't care. There are stuff happening with earnings, which we're going to talk about in a second. And the market doesn't care. It's the Fed cutting interest rates that's going to carry us all over to a higher price level type of deal.
Yeah. S&P watch real quick, Rabih. We're almost at 16% year to date.
Yes.
From our low, I believe, was like Tuesday, April 8th. From that point, it has just marched on.
Yes. Global diversified portfolio is up 20% year to date. Just if you're interested, I'm pulling those up as we speak. Developed market is up 28%. Emerging market is up 30%. And I think the big elephant in the room is gold, which is now up 57% year to date.
Wow, 57.
Crazy numbers. They crossed the 4,000 level, and a lot of people are coming to me. It's like, why is gold going up? Why is gold going up? It's not that gold is going up. All currencies across the board are maintaining their balance next to each other, but all together are getting devalued due to the new trade policy. AKA, gold is not appreciating because there's something happening to gold. Gold appreciating just because the currencies across the globe are all going down at the same pace. But if you only look at gold, this is a very myopic view. Silver is up even more than gold. I think 60-something% year to date.
Wow.
Stocks are at an all-time high, right? Bonds are recovering because interest rates are coming down. Every financial asset is going up. It's not just gold. We like to focus on gold, but that's not the case.
Yeah. Yeah, it's similar to what we've talked about, the nuance of, like, let's say, emerging markets returns. We've got to look at the currency factor there. You're saying the same thing with commodities, gold, silver, and otherwise. It's not, one isn't part of this too, a momentum aspect of gold and silver. Like people are now jumping in and buying it. This is the psychology of trading, right?
100%. Actually, on October 20th, which was Monday, Gold's return was 66.5%. And then over a week, it had a 10% crash down to the 55, right? So this is exactly the behavior of a momentum trade, because it goes up, and then suddenly everyone decides to take their profit. Let's trim off of it. Let's take some profit. And that creates really sharp sell-offs. 10% in a couple of days is not something that you see in a usual market.
Yeah. That's wild though. 57, 60% plus for silver. Those are some wild returns that I'm sure, would obviously turn some heads as like, what's happening? Okay. So, Rabih, anything else on the inflation? So overall good news. We're still expecting a Fed cut in December at this point.
In October next week. Then
October. And then
no
another
meetings
December.
in November. And
Got
then
it.
December is the last one.
And you said it's a foregone conclusion at this point with October that they're going to cut?
Yeah. Actually, there's no, if you look at the Fed funds rates futures, because those are driven by the market, we don't need the government to provide them. There's like almost a zero probability that there's going to be no cuts. There's like a 97% probability there's going to be a cut of 25 basis points, 0.25%. And there's like a couple very slight percentages that it might be a 50 basis point or 0.5% cut. This is, factoring in the fact that you've got Waller on the government board, like on the board, who really is aggressive in how much he wants to cut. So just in case he decided to sway them, I do not know. It's a probability.
Yeah. I want to come back to something you said that I think is interesting. As I read in the doc here, the headline again that you quoted: the only game in town this month is inflation. So, and Wall Street being hungry for data. And then I love the comparison you used of like having a space between your indulgences. I mean, you're referring to eating ice cream to you getting economic data, which I think is just amazing. But it is interesting that you say that, because I do think you get this reading of CPI that is probably pretty, in most cases when we are so data rich and information rich, probably wouldn't have made much headline. It probably would have just been like, oh, great, cool. Like we've kind of maybe reached a peak, or it feels innocuous in a normal setting. But because we have the government shut down, we don't have because we've had that gap between our indulgence of information, it had this huge impact on the market today.
100%.
Is there some truth to psychology there?
100%. And usually when we see the trend, reverting in financial data, it's like, okay, this is a one sample data point. Let's wait until we get more data points. But today, just because this is the only one, until the government opens, like we do not know how long it's going to reopen.
Yeah.
It'll be until they reopen. It could be a month. It could be 2, until you get a new CPI report. They are deciding to take the data as conclusive, although it's definitely not.
It's so interesting. It's such a example of just, we've already talked about this before, like how narratives can shift so quickly. We care about one data point one day, and then the next day we don't. And this is just such an example of that again, it has nothing to do with the data point itself, like meaning our reaction to it. It's the context in which we receive the data point is so interesting to me. Okay, so Rabih, do you feel like we got an ample peek through the keyhole?
Yeah, and we didn't see anything traumatizing, so all good.
Yeah, that's good. That's good. It was just very basic. Okay. Oh, it's so good. All right. Number 2 is something breaking with banks. Now we're getting really dramatic, Rabih.
Honestly, it is not. It is something that raises eyebrows. I'm going to be as blunt about it as possible. So we've been getting the earnings season for, companies. This probably as of yesterday or the day before, just to give you a look of how the S&P 500 companies have been doing. So the year-over-year earnings for Q3 are expected to be 9.9%, excluding the energy sector, that's around 10.7%. So it's a really good year. You're talking about 9.9% increase in earnings from one year to another. Not bad at all. This is for the whole economy as a whole, in a sense, the S&P 500. So out of the 500 companies, around 130 have reported earnings, and 86.2% reported above analyst expectations. And the long-term average of reporting above analyst expectations is usually 67%. So we've got, almost 20% more than usual are beating what the analysts are expecting, which is a very good sign, because analysts are trying to be as objective as they can, and then you're coming in with data and you're beating those expectations, and and expectations factor in growth. So you're factoring in growth. You get to the analyst expectation, which is supposed to be an objective type of growth, and then you're coming in with the actual numbers, and they are even better. So it's a really good earnings season overall, right?
Which supports prices, right? In a way,
Yes.
meaning people, we talk about this, like when prices are high, does it mean we're in an 08, 09 situation where things are just artificially, the gains are artificially created versus the underlying companies actually being healthy? This would support the latter, which is companies are actually healthy. They're actually getting, like, the prices are more supported in reality.
100%. Like prices are going up because of fundamental reasoning, not just because valuation is getting loose.
Yeah.
And in terms of revenue, we talked about earnings. The revenue growth is estimated at 6.5%. And if you exclude, energy sector, it's 7.1. So if you notice, revenue is growing slower than earnings are growing, simply because companies are trying to find efficiency. Probably this is a very, peak at the efficiency and productivity increase that AI and new technologies create.
Yeah.
Your revenue doesn't have to grow at the same pace as your earnings, just because you're finding synergies, you're cutting costs, you're becoming more efficient in how you run your machine, that you've got some gains to capture through your earnings.
Yeah.
So it's a really good earnings season. It's really good. It supports the narrative that, yes, it's fine that equities are going up the way they are, in a sense, in the US. However, we got some data points that relate to regional banks that raise some eyebrows, and the market kind of, during this channel where it was fluctuating 1% up, 1% down, it was a contributing factor. So let me get you some data points. We've got, I would say, two major incidents that caught everyone's attention, and they were talking about them. One is related to Zion's Bank Corp, Utah-owned Zion Bank.
Shout out Utah.
So they reported a profit of like $221 million in Q3, up from like $204 million a year earlier. So it's looking good. But they had to take out a $50 million as a charge-off. They write it off, tied to two commercial and industrial loans facing fraud, contractual default issues. And they decided to also add $10 million in reserves against this exposure. So it could be up to $60 million. So what does this mean? A bank lends you money, and, on average, they more than 90% of the time, they're going to be making their money back. But when they do not, just in anticipation, they decide to put some money on reserve, aka if whoever they lent the money to defaults, they'll be like, oh, we accounted for a possibility of that, so we'll take it from those reserves. So Zion Bank lended auto lenders. We're not talking, usually the pain was private credit and commercial real estate. But now we're seeing auto lenders defaulting on that loan that they took from the bank. And it was up to $50 million with Zion Corp, right? And the reason was not because business is hard. The reason was that there was fraud. This is scary because it seems like there's a loophole in the system. And now, those auto lenders or companies are abusing it, and it's bursting out in their face, and it's going to cause economic damage.
Fraud, have they identified where the fraud, like what level the fraud is at? Meaning, is it the individual, like, person who's getting the loan, like the customer base, or is it at like auto lenders, like third-party auto lenders?
It's between auto lenders. Are we saying that, maybe credit qualifications are getting too loose, we're lending money to wrong people? Slightly, that is part of the fraud.
So more of like a 08, 09...
Not to that extent, but you're lending people
parallels,
in a sense. And type of the fraud also, as I've read, is that they are... those auto lenders are saying, oh, our loans are back, they're going to pay us back. Or, oh, we are making much more money than we actually do. They're playing with the books, kind of, type of deal. But it's a small auto lender. That is what is happening. But this is going to be a $50 million hit to, Zion Bank Corp. At that point, honestly, that day, I think we had over a double-digit decline in the stock price. I think 16%, if I remember correctly. And then another issue that happened was with a Fifth Third Bank Corp, and they have an exposure to a Tricolor Holding auto lender. They went bankrupt, those ones. So Fifth Third posted a Q3 profit of $608 million, which was up 14% from last year. So as a bank, they're doing well, but they had to record $178 million loss, tied to Tricolor's bankruptcy. And the net charge-offs for the quarter hit $339 million. So these losses highlight that credit shocks are not just in commercial real estate or regional banks like we've seen a couple of years ago, but the auto/consumer credit segment is feeding in. Just how the market reacted. The banking sector is under scrutiny right now. The regional bank index fell 67% this month. Investors are reacting to a combination of like bad loan disclosures, fraud allocation exposures, and signs of liquidity stress in the repo markets. I'll get to that in a second. But analysts are saying that even like small negative surprises like these two examples can trigger outsized repricing, like people are overreacting. And honestly, opinions are divided on this. Analysts are saying these are two one-off issues. Do not, make a big overreaction to them. Jamie Dimon of JP Morgan Chase.
JP Morgan, yeah.
Yeah, he said, this is a cockroach. So yeah, you're going to find a cockroach everywhere else. But usually when there's a cockroach, there's multiple. Those do not
They're
exist
nesting
anymore.
somewhere and hard to kill.
They're nesting somewhere, they're hard to kill. So it could be a problem. So now if you take a look back and you look at the balance sheet of banks in this country, especially regional banks, they lend money to multiple asset sources. The asset source could be commercial real estate. The asset source could be student loans. The asset source could be auto lenders, consumer credit, private credit. We are seeing hits across the board with that, which is going to create pressure on regional banks. The good news is this is regional banks, not the too big to fail banks. So they can go bankrupt. They could be acquired by larger banks. It could be stomached as long as their book isn't really infested with those cockroaches, AKA they've got some good assets there. They've got some bad assets. So honestly, especially with the government shutting down, this is the only source of news. Two large write-offs on regional banks spark fear. It's like, what is happening?
Yeah.
What is there? So I was following the credit spreads that happen in the market. So let me tell you a little bit about these. When you are borrowing from, if a government is borrowing, the government has a much bigger ability to pay back than if a company borrows or if an individual borrows. And because of this difference in the ability to repay your loan, the interest rate actually reflects it. So if, for example, I wanted to borrow from you, you would say, oh, you have to pay me 12% back. Where
I'd give you a deal. Maybe say 11.
Okay, 11, great. And then you're making the math harder for me, but it's fine.
Oh, sorry, we'll go 12. We'll go 12.
So, and then if the government decided to borrow from you, because you've got deep pockets right there, you can lend the US government, you're going to tell them, hey, I'll only take 4% from you. So that difference, 12 minus 4, which is 8%, that is a spread between what the government could borrow from you or what I can borrow from you. And that spread can be calculated for high quality bonds, low quality bonds, investment grade, non-investment grade, junk bonds.
Risk assessment, right?
It's a risk assessment.
Yeah.
But in the market that trades every single day, that is liquid, you can look at that spread and see whether it's widening or getting tighter. And if it widens, it means this is an indicator of more risk. So we were following, and this is what we call the option adjusted spread for high yield bonds and for investment grade bonds, all corporate bonds, because the issue is with the banks. And for investment grade bonds, that spread was around 0.75%, less than 1% spread. And it kind of increased from there to 0.8. So it increased slightly. From 0.75 to 8. But with high yield, that was kind of something to look at. We were at 2.75 and we went up all the way to 3.11. So almost a 50% basis point up. And the good thing is that it went back down. So it was a slight panic. It dipped up a little bit and it went back down. What would have happened if it continued going up? It means that this default that has happened with the auto lenders has been contagious, affected regional banks and affected large banks, and the domino effect would kick in. So the largest indicator of 2008 was how this went out of whack and went out of control. This did not happen, but are we seeing cockroaches? Yes. It does not mean that the whole house is invested yet, but there's a cockroach somewhere and we're hitting the winter and bugs should be dead by now. That is the idea. What are they doing there?
Yeah, it's and even the numbers you highlighted, Rabih, with the two banks specifically, it doesn't show, like, again, the numbers you quoted are okay. It basically means earnings were not as good. Like the headline earnings were great or solid, but we had these big write-offs that actually just eat into that. Sounds like you said, a sign of maybe some issues that need to be uncovered, so that it doesn't become like this massive ripple effect, or the contagion doesn't take hold. But even, and then you're referring to the spreads, it doesn't feel like it. I almost think that what happened in 0809, this is one of the positive effects of that, where we're almost like hyper aware of those
We panic
cockroaches.
too early now.
Yeah, like, but again, almost in a good way, especially when it comes to banks and what we saw happened in 0809, that now it's like, again, we're hyper aware of it, which is, again, in this situation, probably a good thing. So it doesn't become contagion, where, and as we all know, 506-7 leading up to what happened, the entire, I mean, talk about cockroaches, it was infestation,
Yep.
uncontrollable infestation. I love that we're just really reaching the bounds of this analogy here. Thanks, Jamie Dimon. So I guess the whole point is, it doesn't sound like our banks breaking based on the numbers you just highlighted. There's not evidence of that.
Yeah, the market panicked for 2 days and then got stuff under control, which for us, because we're on the outside, we're saying, okay, this is not as bad as we thought it was. But had the market continued panicking, you would raise question marks, because they've got access to the balance sheets of these banks, whether they're public or not public, and they're going into every single line trying to understand what's there. So yeah.
So not breaking, but maybe just things to be aware of there. Okay, let's hit the last one here. Rabih, are we feeling the inflation fatigue? This kind of organically happened. This topic kind of organically came about for a couple of reasons. We just highlighted that I just got off a Disney cruise. Talk about fatigue of pricing. Oh my gosh. By the time I'm done with, this is probably one of the reasons.
What was the item that surprised you most with price?
So not being a cruise person, I don't fully grasp like how it all works. I think the thing that caught me the most off guard was internet. So they give you, like, I'm going to say in quotations, internet. It's fake. It doesn't work. But it's like, oh yeah, here's our internet, and it doesn't work at all, which I was fine with, actually. I just didn't have internet. And it was, for the first couple of days, like, great. I didn't even I put my phone away, didn't even check it. Didn't check my computer, nothing for a couple of days. And then some things happened with work, of course, and just, you had to connect. So by day, I think 3, I'm like, okay, there's got to be a way to like actually get access, and figure it out. Well, yeah, you can, for an extra $45 a day if you want actual internet per device per day. So stuff like that, I was really fatigued by. There was multiple other things that I was like, oh, this is not actually included, even though, it's just kind of like that. They get you on the ship and they're like, oh, you want to have fun now? Like, okay, well, you got to pay for that. So I got fatigued. I definitely felt some fatigue by the end of just the, what I'll call like upcharge fatigue. Like by the end, I was like, oh my gosh, I'm so done with this. But I was then talking to a client when I got back, and he was expressing to me just this like feeling like, man, it feels like it's finally kind of catching up, or I just feel like my money's not going as far anymore. And this guy does very, very well, and just feeling it. And then talking to some team members, kind of just naturally, organically, we were kind of sharing the same feelings in our own life. And again, I'm feeling this coming off a cruise. And then I found an article, like just organically, that talks about inflation fatigue. And so this is through Forbes, just came out. And it says, economic confidence hits 5-month low. Consumers frustrated with high prices. It's kind of what you were saying, Rabih, with Wall Street saying inflation is the only game in town.
Mm-hmm.
That's true on many levels. I think people at this point, really across the board now, I think it's maybe trickled upwards in some ways. Like, I think it was really impacting the kind of lower levels of the socioeconomic level, or, economy. And now I think it's just kind of moving upwards, and everyone's really feeling it. So consumer sentiment. So this is a monthly reading on Americans' views on the economy, just how we generally feel. It decreased from the preliminary reading for October was 55.1. They dropped it now. They adjusted it down to 53.6. This is a historical benchmark of 100. This is the lowest reading since May. And I think actually down here, The lowest Americans' view on current economic conditions fell to their lowest level since August of 2022. And then it goes on to say, basically, the data shows that it's basically all around inflation. I think people are just feeling fatigue. They're feeling fatigue of the $18 lunches that used to be $10 and things like that. So I think it is definitely probably the number one game in town of why people are starting to kind of feel, because like if we compare this to what's actually happening in the economy, the numbers we just quoted, earnings, we've talked about this, the stock market, like there's a lot of positives to look at. And yet Americans are still stating they don't feel good about the economy. The question is that simply just fatigue of price increases? Rabih, what are your thoughts?
Honestly, it makes sense. Like from the consumer's perspective, a couple of years ago, let's say pre-2020, inflation was 1.7%. Let's call it 2, right? Now we're just looking at the CPI reading and it's 3. So from 2 to 3, it means a 50% increase in the inflation number, aka what this translates to, the increase in the prices in the items you buy at the grocery usually has now increased by 50% more. Like you expect it to increase from one year to another with a certain expectation.
Sure.
Now that has increased by 50%. This is what inflation of 3% means compared to an inflation of 2. This is literally what it means. So from the consumer perspective, you expect them to increase. They're increasing faster. You're going to feel the fatigue. That's fine, right? It is what it is. You get used to it. For the companies, well, who is increasing those prices? Well, the companies are passing them through. So their margins, their profits are still doing well, which is why we are saying, the stock price go up. Also, these companies they're not all tech companies. They have brick and mortar. They have actual assets that are inflation hedged. So for the market to stay consistent, they also have to reprice upwards the value of these assets that companies hold, aka translates to a higher stock price. But this all ties together. And yes, you should feel fatigued. And I think it's also, as long as consumption isn't hit, that is fine. Because I'm just going to go back to the economics textbook where we say, hey, this is a recession that's demand driven. It's a demand shock, aka people do not want to buy anymore. They also say it's a self-fulfilling prophecy. People expect a recession happening. They themselves start cutting their spending in anticipation of a recession happening, and they throw themselves into this downward spiral, which slows down the economy just because their expectations were down. So we're at this stage where expectations are down. Will that translate to lower spending? Because if it does, based on economic textbooks, this is a self-fulfilling prophecy towards a slowdown. If, this disparity continues, aka between expectations and your actual spending habits, let's stay in that limbo of we're depressed, but we overspend. And the economy will still do fine, stock market will still do.
Yeah, we've said this many, many times. Until behavior changes, it's not going to change. It's like you just highlighted perfectly. Simple supply and demand. People can be frustrated with it, as I was on my cruise, but guess what I'm doing? Still going on a cruise.
You did end up getting the internet because you were replying to my emails.
Exactly.
Yeah.
Right? So I replied to emails. I had to stay. I mean, I shouldn't say I had to, but it got to a point where I felt the need, or I'll say this, the pain of being disconnected, right?
It's larger.
Was larger than the pain of paying the price. And I think that's where we're at still. People are frustrated. We're seeing it bear out on the economic numbers. The other thing I'll just highlight really quick that they highlighted from this report is there's very little evidence an ongoing federal government shutdown deteriorated economic views. So basically saying that wasn't part of it. It's according to this report, they had exact quotes of like frustrated by persistent high prices. According to the survey, I think it's just as simple as that. People are sick of paying high prices for things that it's kind of catching up to us. I think it's just that simple. But to your point, Rabih, we're complaining, we're frustrated, but we keep spending money.
Yeah.
And until that behavior,
I hope we do continue spending money because the other side
of that is the other side of that is not good. Exactly right. Yeah, it is interesting. We complain, including us, like it's frustrating with inflation. The alternative being a spiral of deflation, which is not great. Like we do not want that. Maybe a counterintuitive thought there, but Okay, Rabih, any other thoughts on this, inflation or banks or anything else we've hit?
No, I went to a drive-through 2 days ago to grab a burrito, and she handed me the receipt with a pen to put in a tip through the drive-through the
Yeah.
other day. That was new to me. I gave her the pen back without the receipt. So I don't know what that makes me, but I refuse to jump on the board of let's pay more for stuff.
That's a whole other topic of just tip culture.
Yeah.
I think has changed a lot, but yeah, we've talked about this before. I think Will mentioned this, that the most egregious, I know exactly the place he's talking about. There's a self-serve ice cream place, like frozen yogurt place in Utah, that you literally, there's one person at the counter. They do nothing. They stand there and you serve yourself. You literally get your own cup. You serve yourself. You put all your stuff on. You go to the counter. You weigh it. And based on the weight, they charge you. The person at the counter types in a couple buttons and says, okay, here's your, and then the first thing that pops up is tip. And I'm like, is that from me? Am I tipping myself for serving my, like, it's crazy. The tip culture is wild.
Yeah, that adds to the inflation fatigue. I have to say that
it does.
That adds.
It absolutely does. I think there is some truth to this too, of just all around sensitivity to prices in general. Okay, well, Rabih, again, as always, thanks for sharing your wisdom. I'm sure there's people out there, maybe some young dentists, D4s, brand new associates that are listening. I think they are. That are like, man, how do I get more of Rabih? Like more of his knowledge. I think about this all the time. I'm spoiled because I get to hang out with you all the time. But if you're out there thinking about that, you might be interested in our Dentist Money Launchpad program. So this is everything you didn't learn about money in dental school. It's a 12-week live program. We're going to be rolling this out 2026. This is really meant for D4s, brand new associates. You don't have to be that, but this is who it's meant for, is just helping you kind of master your money, really get a base, solid foundation around your money and everything to do with money. So talking about cash flow and debt, managing your student loans, taxes, investing with confidence, which is where Rabih comes in, because Rabih is going to be one of our lecturers for the program. We also have Daniel Crosby, who has agreed to come on. I'm shouting him out. I'm making it official. Daniel, just so you know, Dr. Daniel Crosby, Carl Richards. We're going to have other dentist mentors that are going to be teaching. So Tony Schichtans from the Educated Associate. We're super, super excited about this. We are currently building a wait list, right? So if you have any interest, we are building a wait list right now. It is growing every day. You can go to dentistadvisors.com/launchpad, dentistadvisors.com/launchpad. There's a button there that you can join the wait list to be notified when this is built and ready to go for 2026. We'd love to have you. For now, if you're still listening to this, you're one of the cool ones. We appreciate you. Rabih, as always, thanks for sharing your wisdom. Everyone, that was our 2 cents. Till next time, have a good weekend. Bye-bye.